Welcome to Talk Tickers, your essential briefing for navigating the nuances of earnings calls. Today, we're dissecting Dell Technologies, Inc.'s second quarter fiscal year 2026 financial results. These dropped after the market close on August 28th.
Yeah, and this call, it presented a really fascinating duality for the market, didn't it?
Absolutely.
On one hand, you saw these incredibly strong headline beats and a really optimistic long-term vision, especially around AI.
Right.
Yet the market reacted with, well, a healthy dose of caution. We're going to unpack exactly what drove that sentiment and, what it means for Dell going forward.
Okay, let's do that. Let's get straight to the numbers first. Dell reported a truly record quarter. Total revenue hit an impressive $29.78 billion.
Wow.
Yeah, that's a robust 19% year-over-year increase, comfortably beating analyst estimates by, well, quite a bit.
And their non-GAAP diluted EPS, that's earnings per share, taking out some one-time items, a key profitability measure that also set a Q2 record, $2.32, just nudging past expectations there.
Okay.
A huge driver for this standout performance was, no doubt, their Infrastructure Solutions Group, ISG. That handles enterprise stuff like servers, storage.
Right, the big iron.
Exactly. ISG soared an incredible 44% year over year to $16.8 billion. Management themselves called it exceptional demand, fueled mainly by their AI solutions.
And when we talk AI specifically, those numbers are, well, they're pretty eye-opening, aren't they?
They really are.
Q2 saw new orders of $5.6 billion and a record $8.2 billion in actual shipments.
Huge shipments.
Which contributed to a substantial and growing AI backlog, $11.7 billion now. So, I mean, the demand is clearly there, and they seem to be executing at scale.
Definitely executing. However, and this is but despite these impressive top-line results and the fact that Dell actually raised its full-year outlook, the adjusted gross margin came in at 18.7%. Now, that was slightly below expectations. And this is what tempered that market enthusiasm almost immediately. It led to a dip in the share price after hours. So the reaction was primarily about these profitability concerns, not really any questions about their, impressive growth.
Okay, so let's unpack this duality then. We've got phenomenal growth, especially in AI, right? But then this immediate market pullback focusing on the margins. For you, the listener, who's trying to get the full picture, where do we begin to untangle Dell's Q2? What's the real story here?
Well, what's truly fascinating, I think, is the sheer velocity and scale of Dell's AI business. I mean, look at this. They've already shipped $10 billion in AI servers in just the first half of fiscal 26.
$10 billion already.
Already. That actually surpasses their entire total for all of last year. Just think about that for a second.
That's incredible acceleration.
It really is.
Yeah.
And they've even raised their full-year AI server shipment target significantly. Now up to $20 billion from a previous target of $15 billion. They expect Q3 to be slightly weighted too. This really indicates immense demand and strong execution capabilities, especially in such a competitive market.
And it's not just abstract demand, right? They're delivering to big players. Management specifically mentioned customers like xAI and CoreWeave.
Exactly.
So this isn't just theory. It's tangible traction with major names in the AI space. And for you as an observer, that's critical for investor confidence, isn't it?
Precisely. And their AI pipeline. It continues its double-digit sequential growth across both enterprise and, interestingly, sovereign opportunities too. Management noted it remains multiples of the current backlog.
Wow.
They're also showing incredible speed. Dell was the first to ship NVIDIA's GB200 NVL72 in July, specifically to CoreWeave. This rapid deployment, this innovation speed, it's definitely a key differentiator. In a market moving this fast, time to market is just everything.
Okay, but here's where it gets really interesting, like you said, and where the market get a little cautious. All this incredible AI growth, it came with a trade-off, at least in the near term. Management stated very clearly that AI is gross dollar accretive, but rate dilutive. For our listeners, can you quickly break down what that means in, practical terms?
Absolutely. It's a key point. Gross dollar accretive means it boosts their total profit dollars, just because they're selling so much volume.
Right, more cash coming in overall.
Exactly. But rate dilutive means that as a percentage of revenue, it actually compresses their overall growth margins. So think of it like this. Selling a lot of something at a lower profit margin percentage can still bring in more total profit dollars than selling less at a higher percentage.
Gotcha.
But it makes that headline margin number, the percentage, look less appealing, maybe a bit weaker.
That makes perfect sense. So naturally, this raises the big question. How do they plan to address that margin pressure going forward? I mean, it's great to sell a lot, but you want to sell it profitably, right?
Exactly. That's the million-dollar or maybe billion-dollar question here. Management did outline several strategies. First, they expect those one-time supply chain costs they had in Q2.
The expediting costs for GB200 parts.
Yes, exactly. For expediting materials, they expect those not to recur in Q3 and Q4. So that should naturally lift margins a bit.
Okay, that helps.
They also plan to improve AI margins through value engineering, making things more efficient, by scaling the business more effectively, and crucially, by expanding their enterprise customer base.
Why is enterprise key there?
Because with enterprise customers, Dell has a much better chance to attach higher margin services, networking gear, and storage solutions alongside the AI servers themselves. That bundle, that's where they can really maximize the overall deal profitability.
All right, the whole solution sale, not just the box.
Precisely.
Okay, let's move beyond AI for just a moment. While AI is clearly the star right now, Dell has other significant engines, right? How's their client solutions group, CSG, that's the PC business, how's that performing amidst all this AI excitement?
Yeah, good question. CSG grew, but more modestly, up 1% year over year overall. Commercial revenue was actually up a positive 2%, which is decent.
Okay.
But consumer revenue saw a decline of 7%. However, and this is interesting for you to note, even with that consumer revenue dip, profitability actually improved in the consumer segment.
Oh, how so?
Mostly due to better product positioning, focusing on maybe slightly higher-end models, and also a generally deflationary environment for component costs. Just cost them less to build those machines.
Got it. And the big tailwind for CSG, the one that isn't really tied to AI servers, is that looming Windows 10 end of support deadline. As of the earnings call, that was just 48 days away. It's almost like a ticking clock for IT departments, isn't it?
It truly is a huge catalyst. They mentioned about half the installed base still hasn't upgraded.
Half? Wow.
Yeah. So that presents a significant and pretty much expected PC refresh cycle opportunity. Dell anticipates this will extend well into their fiscal year 2027, so next year too.
So a multi-quarter, maybe even multi-year tailwind.
That's the expectation. They're clearly focused on execution there. They even launched a new business notebook specifically for the entry-level commercial market, trying to capture as much of that wave as possible. I mean, this isn't just a tech upgrade. It's a forced decision for millions of businesses, and Dell is, very well positioned for that.
Okay, so what about the other part of ISG? Traditional servers and storage, historically core to Dell's business. How did those segments perform?
Right. Traditional server revenue saw some growth internationally, which is good to see. But North America continued to be a bit challenging. However, there's a massive refresh opportunity there too. They pointed out that over 70% of the installed server base is running 14th gen servers or even older. So ripe for an upgrade cycle eventually.
And that's storage.
Storage revenue, however, was down 3%. That was softer than they and the market anticipated.
Right.
And this actually led Dell to revise its full-year storage guidance down. They now expect it to be flat compared to a prior expectation of 3% or more growth.
Any reason given for that softness?
Yeah, they partly attributed it to hyper-converged infrastructure,
right,
or HCI, customers sort of rethinking their private cloud options.
Okay, just for clarity, HCI, that's systems combining storage, compute, networking all in one box.
That's
right?
all. Correct.
And why were those HCI customers rethinking, just moving to public cloud, or?
It seems to be a mix. The rise of public cloud options is definitely a factor, but also Dell's own evolving storage portfolio offering different approaches. But importantly, there were definite bright spots within storage.
Oh, yeah. Like what?
Well, their PowerStore product line grew double digits for the sixth consecutive quarter. That's strong momentum.
Impressive consistency.
And their entire all-flash storage portfolio also saw strong double-digit growth. So Dell is actively working to improve this segment overall. They're trying to increase the mix of their higher-margin, Dell-developed IP storage products. And they recently launched an automation platform specifically designed to address that HCI customer headwind, offering, a more open, disaggregated, and automated alternative.
Okay, makes sense. Switching gears to the balance sheet, how's their financial health looking? Cash flow, debt.
Pretty solid, actually. Dell generated a strong $2.5 billion in cash flow from operations in Q2. They ended the quarter with a robust $9.8 billion in cash and investments on hand.
Healthy, Christian.
Very healthy. And they continued their commitment to shareholders, too. Returned $1.3 billion in capital in Q2 alone. That's part of the $14.5 billion they've returned since the beginning of fiscal 23. So for you, the investor, that's a clear signal of financial health and shareholder focus.
Okay. So looking forward then, their Q3 guidance, revenue guidance was $26.5 to $27.5 billion. How did that stack up?
That was actually above the street's midpoint expectation. So good news on the revenue front for Q3.
But I sense a but coming.
But their non-GAAP EPS guides, the earnings per share forecast for Q3, came in at approximately $2.45. That was below the consensus estimate.
Oh, there it is.
Yeah. And that, as we mentioned earlier, was pretty much the primary factor driving that immediate after-hours stock dip. It's that near-term profitability outlook that spooks some people.
Okay, so putting it all together for the full year, we've got a strong Q2, that's Q3 EPS caution, but immense AI growth still rolling. What does it mean for the whole fiscal year 26?
Well, despite that Q3 EPS caution, Dell actually raised its full-year FY26 guidance.
Raised it, even with the Q3 EPS miss.
Raised it. Revenue is now expected to be between $105 billion and $109 billion.
Yeah.
That's up significantly from their previous range of $101 to $105 billion.
Wow, okay.
And non-GAAP EPS for the full year has also been raised, now guided to $9.55.
So they expect things to get better after Q3.
Exactly. This reflects a clear expectation internally of improved profitability in the second half of the year, across both ISG, the infrastructure group, and CSG, the PC group. They're banking on those favorable mix shifts we talked about, operational efficiencies kicking in, and importantly, the non-recurrence of those one-time Q2 supply chain costs. They seem confident they can manage those margins better in Q4.
Okay, so for you, our listener, we've got this really clear picture now. Strong top-line beats, incredible AI momentum, huge backlog, raised full-year revenue, contrasted with that immediate market concern over the near-term profitability, specifically the Q3 guide. It's a classic divergence, isn't it? Long-term potential versus immediate financial metrics.
It absolutely is. And if we connect this to the bigger picture, strategically, Dell is positioning itself as a top integrator of AI infrastructure. They're not just selling servers, they're offering these comprehensive solutions, bundling servers, networking, storage, and those crucial higher margin services.
Right.
And that raised $20 billion AI server target for the full year. That gives significant visibility into the sheer scale of the demand they are addressing. It really places them squarely at the heart of this massive AI build-out happening globally.
The core challenge for Dell then seems to be converting that immense demand into, let's say, scaled, normalized profitability.
That's the key.
Successfully managing component costs, optimizing pricing for these complex AI deals, and really driving those attach rates for higher margin services that seems absolutely crucial for margin expansion in the coming quarters. This is where the operational rubber really meets the road for them, yeah.
Couldn't agree more. And don't forget the other engine. That Windows 10 end-of-support-driven PC refresh cycle. It acts as a kind of stabilizing force for the CSG segment.
Provides balance.
Exactly. It gives them this valuable dual-engine growth story that isn't solely reliant on the, sometimes volatile AI server part. This broad market opportunity, remember, the overall AI hardware and services TAM, the total market, is expected to basically double from $184 billion last year to a staggering $356 billion by 2028. That provides a really strong long-term arc for the company. The key, however, as you said, will be their sustained operational execution, particularly on that margin expansion piece.
All right. Now, for those of you perhaps eyeing Dell's stock or just fascinated by this situation, let's transition to our not financial advice segment. Let's brainstorm an outrageous but plausible idea for navigating this scenario. The massive AI tailwinds, but that near-term margin squeeze.
Okay, let's play investment committee.
I'm thinking about something like a synthetic covered call strategy. What do you think?
Ooh, okay. A synthetic covered call. That's an interesting way to approach this duality. So walk us through it. You'd go long the stock first.
Right. You'd go long a sensible amount of Dell shares, maybe 100 shares, let's say, reflecting your belief in that long-term AI story.
Okay, you own the shares. Then what?
Then simultaneously you sell an out-of-the-money call option. Probably in the near month, let's target, say, the October expiry at a strike price maybe 7% to 10% above where the stock is currently trading.
Got it. So you collect premium from selling that call.
Exactly. The premium you collect acts as an immediate income stream. It can somewhat offset any short-term volatility or dips coming from those margin concerns we've been talking about.
Okay, so you get some income, cap your upside slightly if the stock rockets past that strike price by expiry. But what about the downside risk? Margins could worry the market more.
That's the crucial third leg. You then buy a deeper out-of-the-money put option, maybe for a similar expiry, perhaps push it out to the November or December cycle for a bit more time. You'd set the strike price, say, 10% to 15% below the current level.
The protection.
Yeah.
So that provides catastrophic downside protection.
Essentially, yeah. It puts a floor under your potential losses if the market, completely misunderstands the long-term AI story, or if something else goes wrong and the stock takes an unexpected dive.
Okay, I see it. So this strategy, this synthetic covered call, it allows you to potentially capitalize on Dell's long-term AI growth, hold the shares,
Right,
while actively managing that immediate profitability noise and sentiment swings with, importantly, defined risk parameters, both on the upside because of the sold call and critically on the downside because of the bought put.
exactly. It's like saying, look, we believe in the big AI story here, but we're not blind to the bumps in the road on margins, and we want some insurance just in case.
A structured way to express a cautiously optimistic view. I like it. Outrageous, but plausible indeed.
All right, let's recap the whole earnings picture then. Dell delivered a record quarter, no doubt driven by exceptional AI demand and really strong ISG performance overall.
Yep. Top line was great.
While profitability was tempered a bit by that mix shift towards those currently lower margin AI servers, management has raised the full year guidance and clearly anticipates margin improvement in the second half.
They're actively addressing those margin dynamics, yeah.
Right.
While still capitalizing on this surging AI market. And let's not forget that upcoming PC refresh cycle providing support.
So the critical takeaway for you, our listener, really boils down to operational execution in the coming quarters. That's the story to watch.
Absolutely. Will Dell effectively translate its dominant AI position and that massive growing backlog into sustainable improving margins? That will be the absolute key thing to monitor.
Well said. This concludes our Talk Tickers briefing on Dell Technologies, Inc. Q2 FY26 earnings. Remember, as always, this is for informational purposes only. It is definitely not financial advice.
Please do your own research and due diligence.
Absolutely. Join us next time for more insights into the latest earnings calls.